Good morning, traders. Today we want to discuss the secrets of a normal third Elliott wave. The secrets of a normal third Elliott wave. Let's get started. All right. So we know that the first wave, the third wave, and the fifth wave can be extended. So now we are talking about the Elliott wave extensions, all right? So the normal third Elliott wave is not extended as such, all right? It's just a normal impulse wave. All right, so we want to understand that the motive waves, all right, so when we're talking about the motive wave, the number one motive wave is composed of the first, second wave, third wave, fourth wave, and the fifth wave. But one more time, the first, the third, and the fifth wave are also motive waves. So those three motive waves can be extended. So if you do not know very much about wave extensions, go to www.24elliottwaves.com and click on wave extensions. All right, but what's happening during a normal third Elliott wave? Now you may say to me, George, I already know about the normal third Elliott wave, and I do not need to watch the full length for this video. I would like to recommend that you watch the full length for this video so you may understand everything that you need to know about the secret of a normal third Elliott wave. All right. First thing first, my friend. So when we are talking about the third Elliott wave, we need to first identify the first and the second wave. This is very important, yes or no. So what usually takes place is that before the third Elliott wave is underway, all right, the second wave is likely to retrace the first wave between the 50% and the 61.8% Fibonacci retracement. All right, so we want to look at how far the second wave retraces the first wave. If we want to watch it at if it's between 50%, if the retracement of the second wave is between the 50% and the 61.8% Fibonacci retracement level, all right, it's likely to be a normal third Elliott wave. We are likely to have a normal third Elliott wave. All right. The number one characteristic of a normal third Elliott wave is that very often, my friend, very often, in theory, the normal third Elliott wave is likely to stop at 161.8% Fibonacci extensions of the first wave. So if you do not know what is Fibonacci retracement, or you want to know more about Fibonacci retracement and Fibonacci extension, you need to go to www.dayprotraders.com and check out what is Fibonacci retracement, so you may also learn to master Fibonacci retracement. Now, sometimes when we are recording videos like this, all right, for experienced traders, they say, George, move on very fast, you're repeating yourself very much. But what I would say that maybe you forget when you start trading first, all right? So a lot of new traders are out there, and they like it when we repeat some of the things that we are repeating over and over, all right? So the first characteristic of the third normal third Elliott wave that is likely to stop at 161.8% Fibonacci retracement, Fibonacci extension correction at 161.8% Fibonacci extension of the first Elliott wave. It's very important to know that. So what usually takes place, professional Elliott wave practitioners know this. So second wave 50% to 61.8% level, they do not assume that definitely the normal third Elliott wave will be completed here, that the price will definitely stop there. They just draw that line there, and they are monitoring the reaction of the price as the price is heading to that point. So we need to put that line on our chart, and as the third wave is underway, we say that if it's going to be a normal third Elliott wave, in most cases, not always, in most cases, it will find a resistance at 161.8% Fibonacci extension of the first wave. So, now if the third Elliott wave is ending at 161.8% Fibonacci extension level, all right, the next thing that we need to know, talking about the secret of a normal third Elliott wave, is that generally, my friend, generally, I'm going to go into the, okay, when it become a bit messy, all right? That's why I draw on my chart. This is the classroom, the accumulation of the knowledge, all right? And then the practice, all right? If you have a normal third Elliott wave, the fourth Elliott wave is likely, all right, my friend, is likely to be shallow. Should be something like 38.2%. The retracement of the fourth wave should not be more than 50% Fibonacci retracement of the third Elliott wave. So here we are. We have a normal third Elliott wave that ending at the 161.8% Fibonacci extension of the third wave. If the fourth wave is underway, in normal condition, all right, should be between 38.2% and 50% Fibonacci retracement level of the third Elliott wave itself. Should be shallow. We will prefer it to be 38.2%. Why? Well, the reason is that if it goes down too far, all right, it will overlap the first wave, which is a violation of the Elliott wave principle. So, because the third Elliott wave is not too long, it's not extended, all right, if the fourth wave goes down too far, it's likely to overlap the first wave, which is a violation of the Elliott wave principle. Therefore, the expectation that you will stop at 38.2%, no more than 50%. Now, what we are doing now, this is the theory, all right? So we want to dissociate, all right? We want to separate the theory from the reality of the market, because a lot of traders know the theory. There are a lot of traders that got an excellent memory and they know everything about Elliott wave, and they will tell you, George, you do not know anything about Elliott wave. But when we test those traders, put them in front of a chart, they find it difficult to apply what they already know. All right, it's like all right, you want to talk about somebody who know about politics, all right, who learn about politics in a classroom, but when you put him on the field of real politicians, they can't win any election. Okay, now this is to make you laugh a bit, all right. So we will expect the fourth wave to be shallow, 38.2%. This is the theory, all right. Okay. Another thing that we need to know when we are talking about the secret of a normal third Elliott wave is that we know that the first, the third, and the fifth wave are likely to be extended. Yes or no? We talked about it at the beginning of this video, and I'm saying again. So now, if the third Elliott wave, if the first wave is not extended and the third wave is a normal third Elliott wave, we can forecast that the fifth wave is likely to be extended. Now let me say this again. If we have a normal third Elliott wave and the first wave is not also extended, we are likely to expect, we can forecast that the fifth wave is likely to be extended, because either the first, the third, and the fifth wave will be extended. If two are not extended, the last one will be extended. So a normal third Elliott wave plus a first wave that is not extended, we are likely to see a third, the fifth wave, correction, we are likely to see a fifth Elliott wave that is extended. So you may say to me, George, I already know this. Okay, now how do we use it in practice? In practice, because when we are talking about Elliott wave, we want to forecast. Now, when we are talking about forecast, we are talking about expectation. Okay, we are also talking about having a bit of idea what is likely to take place before it's taking place. All right. So what we are doing here, we are showing traders. All right. We are revealing to traders the secret of a normal third Elliott wave, so they are able to know what is likely to take place. So when the third Elliott wave is underway, the first thing that we need to understand, the level of 161.8% Fibonacci extension level, all right, of the first wave is a key level that the professional are watching. But sometimes things can become a bit tricky when, okay, that's a good question, when the third area wave is going to be, okay, a complex, a third area wave. Yeah, that's why I'm saying to you the theory and the reality of the market. So as we talk about this now in the classroom, you will see some trader will mark the video down or for one reason or another. Now, sometimes you will see that the price, so you will see, okay, first wave, this was just said, and then it pull back to 50%, 61.8%. That's exactly what I just said. And then the third area wave, boom, to the 161.8% Fibonacci extension level. Good, and we are quite happy about that. All right. So then we say, all right, then the price pull back 38.2%, forming the fourth wave, following by the fifth wave that is not extended. All right. And then you are wondering what's going on here, George. Sometimes the fifth wave, because that's why I say to you, the reality of the market and the theory. What usually happens sometimes, you may see that the third area wave is about to be a complex third area wave. So you may do something like this: 1, 2, 3, 4, 5. All right. But because the first part of the third area wave can be just like this, price goes up all the way, or maybe price may do something like this. Am I talking to myself? All right, let's start drawing more line on the chart. So if we're going to have a complex third area wave, it will be subdivided into 5 manual waves. But the point I'm making to you, I don't know whether I can draw a line to clarify that clearly, is that the third area wave, a portion, all right, I think this is correct way to put it to you, a portion of a complex third area wave may push the price to the 161.8% Fibonacci extension level. And then we may have a pullback. And the trader may think that this is the fourth wave. But that fourth wave is just a manual wave of a complex third area wave. And then the price will continue to go up more to finish the real complex third area wave. But because traders were assuming that the real third area wave has ended at 161.8% Fibonacci extension of the first wave, their wave count can become a bit tricky, because though they are thinking that the multi-wave has ended at the point where the complex third area wave has been completed, the real multi-wave is not yet finished. And though they are calling that pullback here at 161.8% Fibonacci extension, that pullback, this one here, they are calling the fourth wave. That's not the real fourth wave. It's just a manual wave of the complex third area wave. So be aware that a third area wave is not always a straight line as I draw it on my chart like this. A third wave can be a complex third area wave, and sometimes traders are surprised. Okay, they may be surprised because the price may go in straight line like this, so you may see something like this. So if we're going to have a very extended, okay, third area wave, from the second wave the price may go straight away to the 161.8% Fibonacci extension level of the first wave. So at that point in time, you say, okay, this is the third area wave, which is okay because the area wave count is dynamic. It's not that your wave count is wrong. But at that point in time, with the information that you have, well, that's okay. Yeah, this is your third area wave, but we are following the price. Now, then you will see, then the price will pull back a bit, then you say, okay, good, this is the fourth wave. Nothing wrong with that. And then the price will go up like this one more time, but it will not be, okay, extended. So you say fifth wave. So you say this is the end of the multi-wave, but it's not. But it's just because, probably, and then the price will, to your surprise, the price may continue to go up, forming the real third manual wave of the third wave itself. So first manual wave, second manual wave, third manual wave. And then you'll be wondering, what's going on? This is an extension. Now you see it's forming now. And you see, where the third area wave is now extended. When we were here, we thought that this is the end of the third area wave. We thought that we were dealing with, okay, a normal third area wave. Have I made that clear? If it's not very clear, all right, put your comment in the comment section, and I will get back to you. So all I want you to understand is that a normal third area wave is likely to end at 161.8% Fibonacci extension level of the first wave. Remember one more thing is that looking at the price itself, which is the number one indicator, we use also the length or the magnitude of the first wave. I will not go deep into it because we talked about it in another video already. So if the price, if you have a second area wave, a simple strategy is to project the first wave at the end of the second wave, either in length or in magnitude. That's all I would say. So traders use all those tactics to have a bit of idea to set the target for the third area wave. But one more thing, a normal third area wave is likely to stop, not to exceed the 161.8% Fibonacci extension level of the first wave. So tomorrow I will be recording another video about secret of an extended third area wave, and I will be talking more about what we need to pay attention to. All right, so 161.8% Fibonacci extension level of the first wave. After the second wave is stopping somewhere near 50%, a 61.8% Fibonacci retracement of the first wave. All right. Fourth wave likely to be shallow. Preferably, we prefer it to be 38.2% Fibonacci retracement of the third wave, and no more than 50%, because if it goes down more, it will overlap, the first wave, which is a violation of the area wave principle. There is a high chance that the fifth wave, will be extended. Remember that the reason why sometimes a lot of area wave are surprised, or a lot of area wave professional are dumping big sum of money for their firm because a bit of ego, and I've done it before, and I know it all. Those kind of attitude is not good for an area wave practitioner. The reason why, because what is moving the price, all right? The fuel, all right? So you have a car, what is down? You have the engine, you have the fuel. But the fuel, all right? The fuel is the financial, the financial. Okay. So you want to combine the technical analysis with the fundamental. So sometimes the stock or the financial instrument, the market sentiment is not very good, and then that stock, everybody know that they have a business, but the market environment is not very good. All right. So now the price goes up to 161.8%. People pull back. People are not very excited to buy that stock at that point in time. Probably the balance sheet was not strong, or something else, or market environment, or market sentiment. Or suddenly they change, their director, maybe the management team is not very good, and now they change, they have a better management in place, and boom, everybody believes now that this stock should go up. So that's why sometimes we have a complex third area wave, and where, the extension is taking place, especially the fifth wave extension, all right, you will see that no one believes that this stock will go up far, and then suddenly things are improving, and then we see an extension happening in the fifth area wave. Another reason why we need to be careful is because sometimes, as I explained to you, the third area wave, first part of a complex third area wave, may push the price to 161.8% level, and then conditions start improving for the business, and now instead of a normal third area wave, we have a complex third area wave. So by talking about the secret of a normal third area wave, it's just one step at a time. We will say that, this is a normal third area wave if the third area wave is ending there. But anything is possible. A third wave can be extended. So with that in mind, you will be able to use the secret of a normal third area wave to forecast, or to have a bit of idea what is likely to take place. All right? Isn't it good to have a bit of idea what is likely to take place? I think it's good, because if we see a normal third area wave, so price going up, we have a bit of idea that there's a resistance here. If we find a resistance there, we will. So you are buying a hold, that point in time, you will take some profit, yes or no? You will take some profit. You'll be ready to take some profit in that zone. And sometimes for technical trader, you will see that the price will come like this, or sometimes will break a little bit above that level, all right? And then before coming down, all right? Now, you have a bit of a J. You know that we know what's happening here in this zone. Who are those traders? The Elliott way trader, the Fibonacci traders. They are watching this level because Fibonacci trader watching 50%, 61.8%. Fibonacci retracement level of the second wave. Their target is in this zone. Those are aggressive traders. Fibonacci traders are very aggressive traders. All right. So they want to cash out here. Though some of them will try to sell here. Now, you want to cash out, take some profit, pull back. You are ready to buy again, all right? You are ready to buy. And you know that it shouldn't go down very much. So one strategy to trade a 50% Fibonacci retracement level, at that point in time, what you need to do, so we want to go now a little bit deeper into talking about real trading. So what you need to do, as you see the third Elliott wave, so suppose if I adjust my line a little bit very fast, all right, if I move my third Elliott wave right here, suppose it ends exactly there at 161.8% Fibonacci retracement level, okay? And then you see it start coming down. You see it just few candles start coming down here, all right? So what you need to do very fast, highlight that normal third Elliott wave supposed to be, because the wave count is dynamic. So that's why I use the word, I choose my word carefully. It's supposed to be normal third Elliott wave, because until the trend is finished, we can't completely, okay, say that it's a normal. So at this point in time, it's normal third Elliott wave. So what you need to do, just highlight that normal third Elliott wave. I need to adjust again this line so that what I'm saying makes sense to you guys, all right, without violating the wave principle. Highlight the normal third Elliott wave and draw a line at 50% Fibonacci retracement level. Because our expectation that the fourth wave after a normal third Elliott wave shouldn't be beyond the 50% level. This is our expectation. Anything is possible though, but we want to draw that line on our chart and watch the reaction of the price around that zone between the 38.2% and the 50% level after we see a normal third Elliott wave. So after we cash out here and we see that pullback, we are watching the reaction of the price here. Sometimes you see that everything will work beautifully as you're expecting. Sometimes it may not. Therefore, we must use a top-down trading method and take it one step at a time without assuming anything or without imposing our Elliott wave knowledge to the market and say, this is how it should be. Have you ever been trading before? You say, normally everybody should be buying, but they are not buying, they are selling. Or normally this is a sell signal. Why are they buying? Probably they know something you do not know. Maybe they are using the fundamental and you are using a technical analysis, all right? So we don't want to impose, okay, the wave theory to the market, all right? This is about the secret of a normal third Elliott wave. I hope you have found this video useful, all right, and will help you, okay, to improve your wave analysis. If you have any question or suggestion, put it in the comment section, and in due course, I will be busy recording another video, okay, to answer your specific question. Tomorrow, we will be talking about the secret of an extended third Elliott wave. We are the TSTW24 traders talking about the secret of a normal third Elliott wave. Happy trading to you all and speak to you soon.